Amendments in the area of exemption. Friends, most of the amendments we have already discussed in bits and pieces while discussing the other areas. We are just doing the consolidation work now. So, definition of local authority. Friends, local authority is used at various places in notification 12/2017 central tax rate. For example, services provided by the local authority, services provided to the local authority. Now, what or who is a local authority? There is an amendment which tells you local authority, it will include all these things. The amendment is in this area. It includes a developmental board which is constituted under Article 371 and Article 371J of the Constitution. So, the addition is any board which is constituted under Article 371J is also a local authority. Now, friends, what is this board? The President can constitute a board to ensure equitable distribution of funds with respect to 6 backward districts in Karnataka and Hyderabad region. So, in this region, there are 6 backward districts. For the purpose of ensuring equitable distribution of funds to the 6 backward districts in the state's finance budget, the President, to ensure the equitable distribution of funds as which is granted in the state's finance budget, the President can constitute a board. Under Article 371J of the Constitution, this board is a local authority. Goods Transport Agency, this exemption we have already discussed in reverse charge. Now, whenever GTA who has not opted to pay taxes upfront at 12%, and if these GTA services are provided to a registered person, it is taxable under RCM. However, if that registered person happens to be a department of the central government, state government, union territory, a local authority, just now we have seen the definition of local authority, or governmental agencies who have taken registration only for the purpose of deduction of TDS and not for making any taxable supplies, then it is not there under reverse charge. It shifts to forward charge. And after it shifts to forward charge, we had already discussed under notification 12/2017, it is exempted, and so it is exempted over here. So, even under forward charge, the GTA need not pay any GST. Banking. Now, friends, this exemption is not only with respect to the forward charge for that GTA who has not opted for 12%. Even if there is a GTA who is opted to pay taxes at 12%, this exemption still holds good. If he is supplying services to a registered person who is government, who has taken registration only for the purpose of deduction of TDS, it is still exempt. The transaction is exempt. The transaction is exempt whether under RCM or under FCM. Whether GT opts for 12% or doesn't opt for 12%, the transaction per se remains exempted. Banking. Services provided by a banking company to basic savings bank deposit account holders under Pradhan Mantri Jan Dhan Yojana, this is exempted. So, any annual maintenance fees which is being charged to these account holders is going to be exempted, no GST on it. Services supplied by the central government, state government, union territory to their undertakings or public sector undertakings by way of guaranteeing the loans taken by such undertakings or PSUs from banking companies and financial institutions. Friends, here as regards as this is concerned, this is a new entry. Here, this is an old entry. There was an accidental omission of the word banking companies from this entry, which they have included. So, that means if any central government, PSU, there is a bank. PSU takes a loan from the bank for which central government gives a guarantee. Central government charges guarantee commission to this public sector undertaking. This guarantee commission is exempted from GST is what this entry trying to tell you. Prior to amendment, it did not include banking companies, it only included financial institution. It was an accidental omission. So, now they have also covered banking companies. Healthcare services. Services provided by rehabilitation professionals. Now, what is rehabilitation? Any person who has lost his path in life, let's suppose he has been addicted to drugs. So, there are rehabilitation centers who bring them back to life, who remove the addiction of the person who is having with these drugs. So, the services provided by the rehabilitation professionals who are recognized. So, this exemption is available only for recognized rehabilitation professionals who are recognized under Rehabilitation Council of India Act 1992 by way of rehabilitation therapy or counseling and such other activities as covered by the said act. So, essentially it is trying to tell you registered rehabilitation professionals, if they are providing rehabilitation services by means of therapy or counseling or any such activity which is said in the said act, at which places? At, this is very important, at medical establishments, educational institutions, rehabilitation centers which are established by the government, or at an entity which is registered under section 12AA of the Income Tax Act. If they provide rehabilitation services at any other place, it is going to be taxable. It is exempted only at medical establishments, education institutions, established rehabilitation centers, entity registered under section 12AA. Educational services. Now friends, as regards as IIM is concerned, now friends, any service which is provided by an educational institution to its students, faculties and staff is exempted. What do you mean by an education institution? Education institution means an institution which provides services by way of preschool education and education up to higher secondary. Education is a part of a curriculum for obtaining a qualification which is recognized by law or approved vocational education course. Now friends, IIM, the degrees or the courses which were offered by IIM, can you call them as exempted? Can you call all the courses? Certain notified courses were exempted by a entry, separate entry in the notification number 12/2017. We are just talking in general. Other than those notified courses, the courses which are offered by IIM, can they be called as education services which is exempted? Friends, what does this entry notification tell you? Any service which is provided by educational institution to student, faculty and staff is exempted. Is IIM an educational institution is the question. What do you mean by education institution? Preschool education and education up to higher secondary. Is IIM doing this? The answer is no. Is it giving education as a part of a curriculum for obtaining a qualification recognized by law? The answer was no. The answer was no, because IIM did not provide any qualification which was recognized by law. It did not do so. But up to which point of time? Until IIM Act 2018 came into force. IIM Act 2018 came into force from 31st of January 2018, from which date, under the said Act, IIM was declared as institutes of national importance, and hence now whatever the degree which they are providing, there are certain degrees which they are providing are recognized by law. By which law? By IIM Act 2018. So now under this act, the IIMs are empowered to grant degrees, diplomas and other academic distinctions. So now friends, when they are granting degrees, it is a degree, it is a qualification which is recognized by law, and that law is IIM Act 2018. So prior to this period, prior to 31st of January 2018, IIMs were not educational institutions. Post that, IIMs become education institutions, and now if they are granting any degree which is recognized by law, even now not all the courses are exempted. Only those courses wherein a degree is being granted as a qualification which is recognized by law are exempted. Other diploma short-term courses are not going to be exempted even now. So IIMs are empowered to grant degrees, diplomas and other academic distinctions. They can specify the criteria and process of admission to courses or programs. They can specify the academic content of the programs. Right now what we are concerned, they are empowered to grant degrees. These degrees will be recognized under the IIM Act 2018. So only those courses where degrees are being offered will be exempted. The rest of the courses are not going to be exempted. So now friends, diploma or degree courses, they offer postgraduate program. It's a 2-year program. Fellow program in management, it is 4 to 5 year program, where degree courses, a degree is being offered by the IIM. So these are going to be exempted. There are certain short duration or short term programs where no degree is being offered, only a certificate is being given. Faculty development program or executive education. Here only a certificate is being given, no degree is being given. It is not, there is no curriculum wherein a degree which is established or recognized by law is being offered. So therefore in these courses, the exemption is not going to be available. So this is specified in circular number 82/01/2019. These exemptions we have already seen in the real estate sector. If you could recollect, services by way of, friends, as regards as TDR or FSI was concerned, whether for residential or for commercial, whether for monetary consideration or non-monetary consideration to a promoter was taxable under reverse charge mechanism. However, as regards as exemption was concerned, whether it is TDR or FSI, it should have been for residential purposes. It should have been for residential purposes, whether for monetary consideration or non-monetary consideration to a promoter. It is exempted. The promoter need not pay GST under reverse charge mechanism. However, subject to the condition that the flats should have been sold prior to the completion certificate is being received or the first occupancy. That means essentially the flats should have suffered GST. Otherwise, the exemptions shall stand withdrawn, but to what extent? Only to the proportion of the unsold flats. And even in the proportion to the unsold flats, the rate of GST remains 18% on these services, that is your developmental rights and floor space index. On these services, the rate of GST remains 18%, but even though the exemption is withdrawn to the extent of only the unsold flats, even in those unsold flats, the GST which you need to pay is not 18% on this TDRs or FSIs what you have received. The tax will be limited to the extent of 1% or 5%, as the case may be. Affordable housing, non-affordable housing, which is going to be paid or which would have been payable on those flats had they been sold before the completion was done. This we have covered exhaustively in the real estate sector. Similar exemption for upfront amount. Now friends, as regards as long-term lease is concerned, it could be for upfront amount, it could be for periodical rent, it could be for residential, it could be for commercial. The promoter needs to pay GST under reverse charge mechanism. However, exemption is available only for upfront amount and residential portion. The promoter need not pay GST, subject to the same condition what we have discussed in case of TDRs and FSIs, that for those unsold flats, that means which are going to be sold after the completion is complete, exemption is not going to be available on them. And if you could recollect, we have also seen a special time of supply under a notification issued under section 148. Next exemption is long-term lease. This exemption was already there. There's only a clarification which has come. Long-term lease of 30 years or more of industrial plots or plots for development of infrastructure for financial businesses by SIDCO, that is State Government Industrial Developmental Corporation, or any other entity having 50% or more ownership of central government, state government, union territory industrial units, or to the developers in any industrial or financial business area on one-time upfront amount. Friends, please understand this. This exemption for long-term lease for specified purposes by specified persons will be available only if the consideration is one-time upfront amount called as premium, salami, cost, price, developmental charges, etc. Now friends, now arises a situation where upfront amount, the premium is determined in advance. That means long-term lease is going to be, let's suppose, for 40 years and the upfront amount which is going to be payable is 50 lakh rupees. However, this amount is going to be paid in installments. Let's suppose this amount is going to be paid in 4 installments. It is one-time upfront amount determined. It is not periodical rent. It is one-time upfront amount determined, but to be paid in installments. Is the exemption still available? So there is a circular 101/20/2019 which clarifies that if you determine the upfront amount at the beginning, at the inception itself, then even though this amount could be received in installments, even though the amount is received in installments, the exemption still holds good. It will not be counted as periodical rent because the upfront amount was determined in the beginning itself, and it is only that the amount is being received in installments. The next one, this exemption is removed. We have already covered this while we are seeing the proportionate credit. Supply of services having place of supply in Nepal and Bhutan against consideration in INR. The reason for removing this exemption, now it happens to be zero rated supply. So friends, for zero rated supply, service provider in India, service recipient outside India, place of supply outside India, amount should be received in forex or wherever permitted by RBI, it can be received in INR, and of course the supplier and the recipient should not be mere distinct persons. So this is the definition, updated definition of export of service. According to this updated definition, now where the services are being supplied, where the place of supply is in Nepal and Bhutan, amount is received in INR and permitted by RBI, it becomes an export of service, it becomes a zero rated supply, no longer this exemption is required. The next one is in relation to penalty for not carrying an e-way bill. So now friends, when there's movement of goods exceeding the specified limit and an e-way bill if it is not being carried, section 129 lists out the penalty. So there are two scenarios in section 129, section 129 subsection 1 clause A and section 129 subsection 1 clause B. It tells you where the owner of the goods comes forward, there is a different penalty for taxable goods as well as exempted goods. Where the owner of the goods doesn't come forward, there is a different penalty for taxable goods as well as exempt goods. So only on payment upon this penalty, the conveyance and the goods are supposed to be released. Or at the option, if you do not want to pay the penalty, you can furnish a security equivalent to the amount which is payable under clause A and clause B and then get the conveyance and the goods released. There is no amendment in this, there is only the background. Now friends, what happens if you do not pay this penalty? In case the penalty which is prescribed in section 129 is not being paid by you despite carrying the goods without any way bill. So friends, here we go. Confiscation of goods. Section 129 subsection 6 tells you if the penalty which is there in section 129 subsection 1 clause A and clause B, if it is not being paid, but within how many days? Friends, prior to the amendment it was 7 days. Now the 7 days has become 14 days. So this is the only change which I wanted to refer. The goods being intercepted, the conveyance being intercepted and the goods are not accompanied by an e-way bill. In such cases, penal action will be initiated. The penalty needs to be paid, which is mentioned in section 129 subsection 1 clause A and clause B, or a security needs to be furnished as per clause C. If that is not being done within a period of 14 days, the goods are liable to be confiscated. That means the ownership will transfer to the government. Now friends, coming back to the penalty, it gives you a scenario where the owner of the goods comes forward for payment. The owner of the goods doesn't come forward for payment. Now friends, who is the owner of the goods? Now let's suppose I am sending these goods to you. I raise an invoice upon you and I send these goods to you without an e-way bill. Who is the owner of the goods? Am I the owner of the goods or are you the owner of the goods? Point number 1. Point number 2, the goods might go without an invoice. If there is an invoice, either the consignor or the consignee is going to be the owner of the goods. But where there is no invoice, the goods are not only moving without an e-way bill but also moving without an invoice. Now when there is no invoice or delivery challan, who is the owner of the goods to fix the quantum of penalty? So there is a circular 76/50/2018. It tells you if the movement of goods is with invoice or delivery challan, it will be either the consignor or the consignee who is going to be the owner of the goods. That means, let's suppose I send these goods to you and the transportation is going to be your responsibility. Now technically when I remove these goods from my factory gate, you become the owner of these goods because transportation is your responsibility. However, transportation, if it happens to be my responsibility till these goods are supposed to reach your place, then the consignor is the owner of the goods. So if the goods are moving with an invoice or delivery challan, either the consignor or the consignee, as the case may be, they will be the owner of the goods. If the goods are moving without an invoice, without a delivery challan, no invoice, no DC, no e-way bill, who is the owner of the goods to fix the quantum of penalty? Here the owner of the goods will be determined by the proper officer. They cannot mention in law that who is going to be the owner of the goods. Based on the facts, based on the circumstances, the proper officer is going to determine who is the owner of the goods. Amendment in section 52, tax collection at source. A brief background. Section 52, there is a supplier who is making supplies through an electronic commerce operator who happens to be an aggregator, and the consideration is being flown through this aggregator. The person who is buying these goods pays to the aggregator, the eco is going to pay to the supplier. Now any supplies and its consideration is happening through eco. So this is what we have discussed. Supplier supplies to the recipient pays the amount to the eco then is going to deduct his commission, he is going to deduct TCS, tax collection at source, and remit the balance to the supplier. So he is going to deduct TCS at 1% of net value of taxable supplies, and this eco is going to file GSTR 8 on a monthly basis. 10th of the subsequent month happens to be the due date. Now the supplier has made supplies. Friends, please understand, as regards as TCS is concerned, this eco is going to pay a portion of the tax. He only pays 1% of net value of taxable supplies. The balance tax is supposed to be paid by the supplier. So supplier is going to file his returns. He is going to say, this is my outward supplies, so much is the tax. He might have some input tax credit as well. He will adjust that, and he will also adjust the TCS which is being deducted by this eco. GSTR 8 is going to be filed, and this TCS deducted is going to appear in the electronic cash ledger of this supplier. So he is going to file details under section 37 and 39, that is details of the outward supplies and the monthly return GSTR 3B. This is going to be filed by the supplier. Now this TCS deducted, when GSTR 8 is being filed, it will appear in the electronic cash ledger and in GSTR 2A of this supplier. Now friends, the changes. The matching is going to happen. That means, what do you mean by matching? The outward supplies which are declared by the supplier, vis-a-vis the details which are declared by the eco in GSTR 8 portal is going to match it. What it is going to match? It is going to match the state of place of supply and net taxable value. So this is the background what we are supposed to discuss. Now what is the change? The change is, friends, prior to amendment, matching used to happen with GSTR 1 of the supplier along with GSTR 8 of the eco. So matching was only with details of outward supplies, GSTR 1 of the supplier and GSTR 8 of the eco. Now matching is going to happen with GSTR 1 and 3B of the supplier with GSTR 8 of the eco. So the matching is going to happen with details which is declared by the supplier under section 37 and section 39. 37 is details of outward supplies, 39 is a monthly return which the supplier is going to file, vis-a-vis GSTR 8 which is going to be filed by this eco. So matching is going to happen between the details under section 37 and 39. Earlier it only stood as details under section 37. Next change, section 51, tax deducted at source. The background, the supplier, there is a notified recipient. TDS is not applicable on all recipients, it is only on the notified recipients. So there is a supplier, supply of taxable goods or services exceeding 2.5 lakh rupees excluding GST. When you compute 2.5 lakh rupees, you should consider it without GST under a contract. So this recipient, when he makes a payment to the supplier, he will deduct TDS at 2% at the time of making the payment. Then he is going to file GSTR 7, due date is 10th of the subsequent month, and this TDS which is being deducted will appear in the electronic cash ledger of this supplier. Now friends, the question is, who is this notified recipient who is supposed to deduct TDS while making a payment to the supplier? And then obviously is going to give the certificate. So who are those notified recipients? The notified recipients are department or establishment of the government, local authority, governmental agencies, other notified persons as follows. Here you have authority or a board or any other body which is set up by an act of parliament or state legislature or which is established by any government with 51% or more participation by equity or control to carry out any functions. Then you have a society which is established by the government or local authority under the Societies Registration Act and public sector undertakings. So now friends, one clarification which was asked was, as regards as notified persons is concerned, authority or the board or any other body, which is set up by an act of parliament or a state legislature or which is established by any government, qualified by, with 51% or more participation by equity or control to carry out any function. The question was, this qualification of 51% or more equity participation by the government or 51% or more equity participation, was it applicable to both set up by an act of parliament and established by any government, or is it applicable only to established by any government? I repeat the question. Two options. Option number 1, if it is any authority or board which is set up by an act of parliament, plus there should be 51% or more equity participation, 51% or more equity participation by the government. If it is an authority or board which is established by any government, which is established by any government with 51% or more participation, equity participation by the government. This is option number 1. Option number 2, it is set up by an act of parliament, that is sufficient. If it is set up by an act of parliament or state legislative assembly, that is sufficient. Equity participation by the government is not required. Equity participation by the government is required only in those cases where it is an authority or the board which is established by any government. So, of these two options, what is the interpretation one needs to take? So, friends, the circular has clarified this qualification, 51% or more of equity participation by the government, this qualification is applicable for both A and B. That means it should be an authority or board which is set up by an act of parliament plus equity participation of the government. Authority or board which is established by the government plus equity participation by the government. Only in such case it will be a notified recipient who is responsible to deduct TDS for receiving inward supplies in excess of 2.5 lakh rupees. Now, next question is, friends, let's suppose the supplier and the recipient. What if the supplier and the recipients are notified persons? Say, for example, there is a public sector undertaking who supplies to another public sector undertaking. There is a public sector undertaking who is supplying to another public sector undertaking. Let's suppose 3 lakh rupees is the value of supply. Now, is public sector undertaking a notified recipient for the purpose of section 51? The answer is yes. You have a public sector undertaking. Now, should this public sector undertaking deduct TDS for the supply made by another public sector undertaking? So, friends, here there is a notification 73/2018 which tells you TDS provisions shall not apply to the supply of goods or services or both which takes place between these notified recipients. So, between these notified recipients, if there is a supply of goods or services which takes place, then the TDS provisions shall not apply. Friends, please understand, this is not only amongst PSUs versus PSUs. It is not only amongst PSUs versus PSUs, it is amongst any person. Say, for example, one local authority is supplying to another local authority, TDS provisions will not apply. Public sector undertaking is supplying to the local authority, TDS provision will not apply. So, either in the same group or to any person inside this notified list, TDS provisions will not apply for supply made amongst or between these notified persons.